Good morning, everybody, and welcome to Singapore Property Show 2021 by MediaCorp and our partners, 99 Group, as well as top real estate agencies, Propnex, ERA, Huttons, Orange Tea, and SRI. My name is Daniel Martin from MediaCorp. It is my absolute pleasure to be your host today. This is the final weekend, so I'm glad you could be here, and this is our first session in Hall A for this Sunday. Going to kick things off as I'm going to be joined by Stella Teo, who's Associate Division Director of Propnex. Now, Stella's going to be touching on the topic of asset inflation. Now, we all know how important it is to protect our cash from inflation, but how could property potentially be a really good vehicle to do this as well? Stella's got some answers, plus she'll also be sharing more on a highly anticipated new launch. It's called the Avenir, so stay tuned for that. Oh, and don't forget, 2 lucky winners after each session will walk away with a $100 cash prize each. How will you take part? Well, there'll be a link or a QR code that appears on your screen later on. Make sure you scan that or click through and you'll be in the lucky draw. I'll be spinning the wheel at the end of this session and announcing those 2 lucky winners. But right now, when it comes to asset inflation, Stella, tell us what we need to know. Take it away.
Hello, everyone. Good morning. Thank you for tuning in this morning. I'm going to share with you asset inflation, but I'm going to give a very quick overview of stuff in the sense that this topic can bring you into greater depths, but because of lack of time, I'm just going to give you a flavor of what's happening in the world today. Okay, so just introduce myself a little bit. I graduated from NUS with majors in economics and statistics. I used to work in a stock booking firm as an equity sales director, and I joined real estate at the end of 2010. So been with Propnex since day one, and I have so far been here about 10 years, really enjoying the business a great deal. Okay, now let's get on to business. In a recent report by CNN Business, they are saying that people are panic buying homes as prices skyrocket around the world. House prices soared as the world suffered its worst slump since the Great Depression, from New Zealand to the USA to Germany, China, Peru. The same phenomenon has taken place in many places, and many buyers are panicking because for some of these people, prices are going beyond what they can afford. So if you look at this underlined here, it says that prices around the world, has risen by 6.7% between fourth quarter of 2019 to fourth quarter of 2020. In just this 1 year, this is the fastest year-on-year growth in the past 20 years. So this is really, really an event that is unprecedented. So why are asset prices rising so rapidly during the pandemic? That is the question on the top of many people's minds. Now, I'm going to address the cause of this phenomena, what are the effects, the cost of not preserving your purchasing power, and then I'll address what is happening in the world right now in the financial markets, and then what the Federal Reserve is telling the world, what are we actually seeing, and going forward, there will be definitely greater volatility and uncertainty in the markets, and where do professional fund managers deploy their funds. So I'll be talking about real assets versus financial assets, knowledge-based risk management, and with that, let's see through what the most profitable company in the world is doing, and outperforming safe haven right here in Singapore. Okay, if you look at this chart, we have the G10 central banks, averaging a monthly QE pace. QE stands for quantitative easing. QE pace in 2021 as a percentage of annual nominal GDP. And what is more important is that you take note of what is happening here. The central banks are purchasing an unprecedented US $1.2 billion in assets every single hour. Can you imagine that? How much the central banks are pumping money into the markets? Okay, so you can see that we have the whole world is flushed with liquidity. Let's look at the U.S. Money supply, M1. What is M1 money supply? M1 money supply essentially means money in circulation plus your checkable deposits in banks. So that is things like your bank accounts, how much money you have, the money that is in circulation. So this is just liquid money. That's M1 money supply. Okay. For M2, M2 will include M1 plus M2 money supply includes M1 money supply plus money market funds. Okay, that means the big quantum funds deposited by the big hedge funds and so on in the financial institutions. So you can see that since the founding of USA, that is 243 years till 2019. USA has been founded for 243 years, and the cumulative money supply M1 in the market was US $4 trillion. But in 2020 alone, okay, in 2020 alone, it has risen from 4 trillion to 18 trillion dollars. That is a lot of money. It's grown more than 4 times in the last 1 year. And if you look at the deficit increase, let's look at the stimulant measures. These stimulant measures are actually fiscal measures. So you have monetary measures, you have the fiscal measures to counter recession. So just 3 months in 2020 alone, the government has spent more than what they have done so in 5 recessions. All these 5 recessions didn't add up to the amount that was spent in just 3 months in 2020. So you can see the money supply has gone up tremendously, right? You can see this. This is a really a phenomenon that that's really rocking the whole world right now. But a lot of this money supply, they are transfer-driven consumption. They are not really much into the GDP growth. So why are assets rapidly rising? Let me, we have discussed about the cost because it's massive injection of liquidity. Let's now take a look at the effect, the disconnection between what is happening and the asset inflation that we see around the world right now. Okay, so you can see that in these charts here, okay, on the left, you will see that this is the US real GDP. Real GDP and nominal GDP, there's a difference, and real GDP is actually adjusted for inflation. Nominal GDP is not adjusted for inflation. So you can see that we are looking at economic recovery in the USA. The first quarter of 21 alone, it has gone up 6 point. The GDP has there's a GDP growth of 6.4%. In the second quarter, it is expected that it will go up to 10%. And the third quarter, we are looking at 7.5%. But this is more or less transitory. It is short term. It is not going to be like this forever. So according to the US government, this is just a short-term phenomena. Okay, so the Fed's forecast is that it will drop back to about 2% by the end of this year. So let's look at the chart on the right-hand side. If you follow this line here, the gray line, okay, this gray line here, this is the gross domestic product, okay, and then this blue line here, that is the debt, securities, liabilities, loans that the government has. You can see that the money supply, velocity of money supply of M2, velocity of money meaning the money that is in circulation in the economy. Okay, you can see that even though they pump out a lot of money supply in the markets, but the circulation of money, the velocity of money going around has dropped down by a substantial amount. So much so that you can see that the GDP growth, the gray line, isn't that much. There's some growth definitely, but it's not something that is a very high rate of growth. But if you look at the amount of debts that have been incurred, the blue line, it has grown a lot, but at the same time, the velocity of money has come down. That means this growth in the depth, in the injection of capital into the market, actually isn't going into the real economy. Okay, so you can see from this chart, purple line shows you the cumulative real GDP growth. So this is the real economy, what's happening here. And the orange line is the cumulative S&P growth. That means the stock index in the USA, S&P 500 growth. So the stock index has grown by 195% versus the real economy of growing 22%. So that is about 9 times more money, more growth in the financial markets as compared to the real assets, as compared to the GDP growth. So markets are actually disconnected from the economy. Okay, now let's look at the cost of not preserving your purchasing power. Let's look at the recent financial bubbles. Since the 1980s, we have several financial bubbles. And if you take a look at what's happening in the world, financial bubbles usually may last anything from 2 years to 5 years. Usually it takes several years. This is the span of time. This is about 4 to 5 years. And you can see that the recent one, you can see here, FANG stands for Facebook, Amazon, Netflix, and Google. Okay, so you can see that this so far is only a year plus, right? So we will probably see a little bit more extension over the next couple of years. So financial bubbles don't come and go within a short span of time. They do stretch over a few years most of the time. And let's look at this chart here. The black line shows you, if you look at the legend on top left, the black line shows you the index, iShares, S&P 500 growth. These are in the growth stocks. Growth stocks are essentially, most of the time, the tech stocks. And then if you look at the orange color line shows you the S&P 500 value stocks, okay, value stocks. So you can see that more money has gone into the tech stocks versus the value stocks. Usually in periods of high inflation, people will go for value stocks. Okay, when interest rates are high, people will go for value stocks. But when the interest rates are low, they will go for tech stocks. So you can see that the tech stocks in the last several years has gone up substantially compared to the very beginning of this chart in 2009, right? In 2009, after the last global financial bubble in the crisis in the USA, the subprime crisis, the Lehman crisis. So since then, you can see the decoupling of the two charts. Tech stocks has performed 650% since 2009 versus the value stocks that has performed about 350%. But then let's take a look at on our home front. If you had put money in a bear market, for example, okay, let's say in any capital markets in the world, if you have put any money in a bear market, definitely you will lose money when the market is going down. So a bear market destroys capital, but not participating in the bull market has an equal impact on the end results. That means when there's a bull market, everything has gone up, prices has gone up, and you are not participating in it. It is as good as, you know, losing money in the bear market. The results are the same. And let's look at on the home front. If you have put money, okay, because, well, CPF does pay us a good 2.5%. If you have put money in CPF between 2009 to 2021 in this period of about 12 years, compounded at 2.5% per year, you will get a total of 34.5%. Versus somebody who put money in let's say the US stock market in the iShares, this is the index, they have gained 650%. So sometimes, yes, if we look for a place to park our money where it's very safe, but we have to compromise on the returns for sure, okay? And let's look at what is happening in the world right now, what the Federal Reserve is telling the world. So this is an FOMC meeting notes, minutes of meeting, and this is very recent. This is just last month. Okay, Federal Open Market Committee meeting, and you can see I'm giving you a snippets of what is stated in this sheet over here. So on the right hand side, you will see certain statements that were made in the minutes, and you know a lot of fanciful words there. But essentially, what they are saying is that there will be inflation, okay, in the immediate term. As you can see just now, I showed you the second quarter, they are projecting that it will go more than 10%, but that is transitory, is temporary in nature. And then they are thinking of talking about tapering. What is tapering? Tapering, that means they are reducing the QE, okay, taper off the QE, reducing the amount of money that is being pumped into the economy through quantitative easing. So that's tapering. The last round, when that happened, Obama administration did QE 1, 2, 3. At the end of it, when they started to taper, there was this syndrome known as taper's tantrum. The stock market took a heavy beating when the tapering kicked in. So you can see that there's another clause inside this meeting, and they are saying that asset inflation, essentially what they're saying is that asset inflation will continue, okay? And then, but then, however, risk is now elevated. So these are the notes from the recent meeting right now by the Federal Reserve. So you can see that they are just summing here what is happening in the markets. And then, but what are we seeing right now? You can see that in this chart, pandemic distortions to core inflation should peak in April or May 2021. So you can see the impact of pandemic effects on core PCE inflation. What is PCE? Personal consumption expenditure. Okay, and take note that this is one of the sources for this research is from Goldman Sachs Global Research. So you can see that the long-term target for inflation is 2%. This is what economists also term as creeping inflation, between 1 to 2%, where prices crawl up steadily over time. Okay, 2% inflation target. So this is what most economists will try to achieve for the long term. So, but you can see that in April last month, it seemed to have gone up quite a fair bit to close to 3%, right? Just a shade under 3%. And you can see that, I'm going to show you the next chart here. So you can see the legend on the top left-hand corner. Light blue color means temporary shortages and supply disruptions. The dark blue line, virus-sensitive services and apparel. So you can see from this red line here that the total contribution to year-on-year core PCE inflation is around about 0.5. Okay, it's around about 0.5. So this contributes to the PCE inflation. So, but what happens is they are forecasting that because of the pandemic, when things get better, when the vaccines are more rolled out, there will be the COVID situation will be under control, and because of that, okay, these two portions here, right, the temporary shortages and supply disruptions due to the pandemic, as well as the virus-sensitive services and apparel, will cause prices to come off a little bit, and then the inflation will come off because of that. Okay, so just to explain a little bit, temporary shortages, when there are shortages due to logistics issues and all that, prices will be affected, prices will go up. Okay, when there are supply disruptions, when there isn't enough supply to cater to the demand in the market, prices will also go up. That's why you have a short-term inflation, but in the coming months, they are expecting that it will come back down to hover around 2% mark. Okay, then let's look at the Goldman's inflation outlook. So Goldman Sachs is saying that we have inflation. You can see on the left-hand side here, you have the headline inflation and the core inflation. Okay, essentially, what is the difference between headline inflation and core inflation? For core inflation, they are removing food prices and fuel prices of food and fuel. Okay, because these tend to cause distortions in the core inflation. So the core inflation is less volatile compared to headline inflation. So you can see that what Goldman Sachs is forecasting is that the inflation outlook will stabilize after a while to hover around this level, okay, about 2.5% level. And we are on the right hand side, you can see that there's this arrow here, right? This dark red arrow, dotted line arrow. You can see that it is pointing down. So what is this about? Plans to buy cars, homes, major appliances all tumbled in May. Okay, the plans to buy. Expectations of decelerating growth and softening labor market conditions in the months ahead. So you can see that this chart on the right-hand side, consumer spending intentions, has been gyrating a lot, up and down, right? Whipsawing up and down all the while. But you can see that in the recent last 1 month, right, it has come off. And because the intentions have been coming off, there are therefore, because people are putting on hold their big ticket purchases and so on, because of that, they are expecting that inflationary pressures will be eased somewhat. But as you can see from the chart, this is probably temporary. It may go up again, right? So this is the markets are wild. Things are so uncertain at the moment. And so going forward, there'll be greater volatility and uncertainty in the markets. So let's look at what's happening in the US market regarding the usage of short-term funds. Right now, if you put money in the banks, okay, for the funds, if they put money in financial institutions, it is currently trading at negative interest rate. That means, you see, normally when we put money in the bank, we expect some sort of interest payable by the bank to us. So it may be low, it may be 0 point something, but we still expect an interest to be paid to us. However, what is happening now is that we have this issue of negative interest rates. That means if you were to put money with the financial institutions, you have to pay them a fee instead. You have to pay them interest instead. That's what we mean by negative interest rates. So because of that, there's so much money sloshing around in the market. And if you can see on this right-hand side here, we have the treasury bills, 28-day treasury bill. Treasury bills are short-term, like a bond, but it's short-term. That's why it's called a treasury bill. Bonds are usually for a longer term. And you can see that the amount of treasury bill that's out for sale was about 40 billion. Okay, you can see here 40 billion. However, what was the subscription? The subscription was 166 billion. So that is more than 4 times oversubscribed. Because there's so much funds in the market, even though the treasury bill is 0%, you know, they don't pay you interest. People are still subscribing for this treasury bill because it is better than putting in the bank and having to pay the bank interest. They better buy a treasury bill where they pay 0 interest. Okay? So in a way, it's better off for the fund to put money elsewhere rather than in the banks. Okay, so that's why it's oversubscribed. And you can see on the left-hand side, SOMA. What is SOMA portfolio? SOMA at the bottom here, you can see SOMA is System Open Market Account. And they have been, so their portfolio now stands at $7.18 trillion. And their quantitative easing every month, the QE monthly purchase of treasury bills is 80 billion, and their MBS mortgage-backed securities, 40 billion. So total is 120 billion worth of purchases every single month. Okay, so you can see that they are pumping a lot of money in the market. So when there's a lot of money in the market, what happens is that interest rates will be driven down because there's a lot of cash in the market, a lot of money in the markets. Interest rates have been driven down to 0, and right now it is negative, right? Going into the negative territory. And that is why if if the funds have a lot of money to park, they have to park it somewhere. And instead of parking it with in the form of treasury bills, which are oversubscribed, see all those people that are oversubscribed now, where can they now park their money? What can they do? So they will find a way to park their money such that they will not have to pay the banks any interest at all. So right now, there's this thing called the Federal Reserve Federal Overnight Reverse Repo. Okay, that means, see, banks have a certain certain ratios that they have to meet. Okay, the banks, and when they have too much cash in their banking system, they have to put the money back with the central bank. So let me just tell you a little bit what is the difference between Fed and the Treasury. The Federal Reserve is a central bank like our MAS, and the Treasury is like our Ministry of Finance. Okay, so these funds, they want to put money back to the central bank and through a reverse repo, overnight reverse repo, and if they do that, these are all backed by treasury bills. So when they put the money in with the central bank, they also get treasury bills from the central bank in that sense. So they are not losing out by putting money in the institutions, okay, in the financial institutions where they get negative interest rates. So if you look at the next chart, overnight reverse repo, you can see that usually banks will adjust their ratios every end of the quarter, so that they will adjust the funds available and the funds that they will put in the overnight reverse repo with the central bank every end of the quarter. But you can see that recent months, you see what's happening. This is craziness. This is a very, very new phenomenon that are being talked about by hedge fund managers. And this is a very, very new phenomena. And so you can see that the bank's balance sheets, they are unable to warehouse. They're unable to warehouse any more reserves at current spread levels. So they are so chock full of reserves. So they have to park their money somewhere. And because they have to park their money somewhere, they park it back with the Federal Reserve. And this amount stands at, as of 26 May report, it stands at $450 billion. The system just cannot handle so much cash. And so they have to park it somewhere. They park it with the overnight reverse repo. So tapering will definitely happen. Okay, it may be sooner than expected. So when that happens, of course, the financial markets, the equity markets will take a tumble. So let's look at on the right-hand side here, we have a chart here. The blue line shows you the 10-year US Treasury note. This 10-year, this essentially is like a 10-year long-term inflation, 10-year inflation. Okay, sorry, not inflation, interest rate. Okay, so you have the gray line. That is a 2-year US Treasury note. So you can see that the short term, the 2-year interest rate is very stable. Okay, it's stable for the immediate short term, immediate 2 years. Stands at about 0.25%. However, we are expecting that the long term, the market is expecting that the long term interest rates may go up to as high as around 1.7%. Okay, over the is a 10-year long-term interest rate. So you can see that there is a decoupling here in the sense that the long-term interest rates are already shooting up. Okay, the short-term interest rates are still stable. But what is more important? Okay, what is more important is to take note that the US dollar index is also coming off. It means that the US dollar will continue to weaken. So these are which two evils are worse? Is it the rising interest rates or is it the weakening US dollars? Looks like the weakening US dollars will impact the economies more so. Okay, and so if you are holding on to US dollars, you may want to take a relook, because the US government is pumping so much money into the markets. The US dollar, because there's a lot of supply of the US dollars, definitely the US dollar will continue to weaken in the years to come. Okay, so there's something for you to take note. And how about in China? What's happening in China? China, you can see that the credit impulse is turning negative. What is credit impulse? Credit impulse is um, the growth in the use of credit over the GDP. Okay, so the growth in credit. So the credit impulse in China has come off, but the producer price index, the PPI, usually lags behind by 9 months. So you can see that in China, it's already kind of tapered off already. They have been tightening their credit since early 2021, so it's been coming off. So they are managing it very nicely in China. Okay, so when this happens, when there is less credit growth, um, it means that there will be lesser inflationary pressures. And in turn, when there's lesser inflationary pressures, it is kind of good for the markets, for the equity market, for the financial markets. So you can see that this is a stock index of Shanghai Shenzhen 300 stocks, and you can see that it has already come off. Yeah, you can see that the index has already come off. So they are managing it rather nicely in China. How about the let's look at this is from Goldman Sachs again, investment research. Of the chart sales growth for FAANG. What is FAANG? That is Facebook, Amazon, Apple, Microsoft, Google. Okay, this the sales growth. Okay, the sales growth of these companies relative to the S&P Standard and Poor 500 stocks. So you can see that last quarter, fourth quarter of 2020, it was standing at 29% growth. Okay, and then you can see that to date, okay, the first quarter of 2021, the growth has gone up to 41%. So these companies, these 5 companies, they are so huge and yet they are doing so well. Their growth has been phenomenal, 29% followed by 41%. So you can see that although they have grown in terms of sales over the last half a year so much, but let's take a look at what's happening of their stock performance relative to the rest of the S&P 500 stocks. That means the top 5 companies as their share of the 500 total. So you can see that the market cap has dropped from 25% to 21%. That means their prices have come off. Okay, sorry, I shouldn't say prices. I should say that their total market capitalization, because market cap is a function of their share price, isn't it? Multiplied by the number of shares they have. So the market capitalization relative to the 500 stocks, it used to occupy 25%, but now it has dropped to 21%. So it means that what I showed you earlier on is that the sales has gone up a lot. The last quarter gone up by 41%. However, their percentage of the market cap vis all the rest of the stocks has come down 21%. Okay, come down to 21%. So you can see that what is essentially happening is the hedge funds, okay, are dumping their tech exposure, okay, and they are now rotating into value sectors. Okay, number 3, I would like to discuss about where fund managers deploy their funds, real assets versus financial assets. So where are they deploying their funds? Let's look at this chart here. Let's focus on the blue line. The blue line is real assets versus financial assets, meaning what is the amount of money that is put in real assets. Real assets can be real estate, it can be infrastructure, it can be power station, power plants, and so on. Okay, these are real assets. It can be commodities. All right, these are examples of real assets versus financial assets. So in the past, you can see that when it peaked over here in the 1980s, right, around 1980, it peaked at about maybe 1.11% around that. Okay, well, that means it's 1 to, sorry, not 1%, it's 1 to 1. That means the amount of money going into real assets is the same as the amount of money going into the financial assets. But you can see that as of now, it has tumbled all the way to here. right? So that means the amount of money that's actually going to real assets has tumbled all the way down. It is now currently at an all-time low versus the amount of money that is going into financial assets, down to maybe about 0.1. Okay, instead of 1 to 1, it's now down to 0.1. So in this decade, in the 2020s, in this decade, more so we'll see inflation rather than deflation. We'll see real assets to grow much more than the financial assets, because right now the real assets are is at an all-time low compared to the amount of money that has gone into the financial assets. So fund managers will definitely adjust their portfolio to shift their money into real assets. So so they are recommending that that real assets be bought, commodity-linked exposure, and real estate. So what are they selling? They're selling their long-term bonds, tech and growth stocks. So if you see this chart here, real assets outperform financial assets during periods of inflation. So let's look at the correlation of real and financial assets with inflation, okay, since 1950. So since 1950, whenever there is inflationary pressures, when there is inflation, people, 73% of the time, people put their money in real assets. Versus, let's look at the financial assets, 5% only, okay? So usually when inflation, remember we talk about the long-term interest rates is already trending up, whereas the short-term, the 2-year interest rates are still stable at low, but in the longer term, we are seeing inflationary pressures, and that's why we do see that if you look into the crystal ball, it's like telling us that, you know, because of inflation is coming in, there'll be more pressures, more money will be going into real assets. So what are fund managers doing? They are buying outright real assets. They are buying cash flow driven assets. Cash flow driven assets meaning assets that will not just perform in terms of pricing, in terms of capital values, but also to give you a dividend, a return, cash flow driven. Okay, so like if you put money in real estate, then you get rental yield, for example, or maybe power stations, you can impose tariffs and so on. And so and then they're putting money in assets that are likely to retain value while still paying attractive returns. But of course, the trade-off is lower liquidity. Okay. All right. So house prices are running way ahead of inflation. There is housing disconnects from rent and the CPI. So let's look at the green line here. The green line is the consumer price index. And what is the red, the maroon line here, the brown line here is owner's equivalent rent, right? So owner's equivalent rent, I believe it is what owners will be paying themselves for the rent that for their housing needs. Okay, so it's owner's equivalent rent, and then you have the next one, the light blue line, that is Case-Shiller home price index. So what is this Case-Shiller? This is interesting. They are tracking the performance of prices of the same property, the repeat sales of the same house. Okay, that means this house, if you buy now and you sell and then buy and sell and buy and sell, this is the tracking of the prices. The light blue stands for the top 10 metros. That means the top 10 cities, okay, the top 10 most important cities in the USA. And whereas the dark blue line here is the national level. So you can see that the Case-Shiller index for repeated sales of the same home has been climbing up, right? Whereas the consumer price index has been stable. You can see that around this period of time, around 2012, right, it was very close, but now it is on a divergent path. And so what we see in the coming years is that price gain will be definitely more than the rental gain, meaning the appreciation of the assets of real estate, the appreciation in the price will be a lot more than the rental itself. So even if the rental is not much, okay, in terms of yield, it will be more than made up by the increase in the value of your homes. That's what this chart is trying to say. And okay, so let's look at what the well-to-do in the US do to keep pace with asset inflation. So you can see that the red line is the core consumer price index, the core CPI, and then the blue line, it is the existing housing prices, the home prices. So the core consumer price index, the red line is pretty stable, right? It's pretty stable, but you can see that for housing prices, ever since the subprime crisis in 2009 till now, you see, last financial bubble in 2009, you can see that the price dropped quite a fair bit, but now it has gone up to around here, in spite of the raging pandemic that's happening around the world. So you can see that prices have gone up quite a fair bit. And if you look at the chart on the right hand side, okay, these are the percentage change in sales from a year ago in terms of the price range of the homes, okay, the properties that the change in prices of properties according to the value, the quantum. So you can see that on the mass market segment, okay, these are each is about about 40 and 35%. Okay, so makes up about 70 to 80% of the homes are mass market homes, but the mass market homes are not increasing prices much. Okay, but let's see what the rich are actually doing. The well-to-do, they are building wealth, and that is why homes that are more than $1 million in US dollar, in US, homes that are more than $1 million $1 million listings, they are seeing a substantial increase in the prices. Okay, so the well-to-do, they are actually building wealth, but a lot of people who are living on subsistence levels, right? Their housing, they are not able to afford. Okay, because wages, in a way, their wages are not able to keep up with asset inflation. So because of that, they are not able to upgrade to a better home, because prices of the better homes, the higher value homes, are escalating a lot in the USA. So knowledge-based risk management, the most profitable company in the world, okay? And let's see what they're doing. Okay, so this is the most profitable company in the world. You can see that previously it stood at what they have, right? Their assets stood at $1 trillion. After that, it went to 4 trillion, and now it is doing about 7+ trillion dollars. And in terms of the profits that they are getting, can you see that the profit, okay, is they are doing a profit of $322 billion, right, in this year, 2021 alone. Can you see that this company is so profitable? Their assets are growing, their profits are still good in spite of the pandemic. So let's see which company is this. First and foremost, let's look at the various big companies in the USA. We have Apple. Apple, their profit was about close to $62 billion. We have Microsoft, Facebook, Netflix, Amazon, Visa, JP Morgan, Bank of America, Johnson & Johnson, Intel, Home Depot, Walmart, and so on. All these companies cannot beat the most profitable company in the whole world. And what is this company? This is the Federal Reserve. Okay, they have made $322 million in profit. But do take note that even though their profit has gone to 322 million, this is lower than what they had before. Okay, what they had before when their assets were at 4 trillion, now the assets are higher, but the income is actually lower. Okay, why is this so? It is because of lower interest rate. So when there is lower interest rate, the income is also lower. Okay, this just to share with you that it reflects a lower interest rate. Okay, but this Federal Reserve, how did they make this money? $322 billion. How? By printing money. Okay, but in spite of them printing money and making all this $322 billion in the recent year. Let's look at what their debts are. The US has a lot of debts, even though this is about seven plus trillion, 7+ trillion. But so this is a debt, right? Because they issue treasury bills and all that. So this is a debt obligation in a sense. But what is their debt obligation? It total is $28 trillion, and these bonds, treasury bills are subscribed not just by people in the USA, but not just subscribed by themselves, but also by overseas investors like China, Japan. They also put money in the treasury bills. So, and what other obligations do they have? They have their medical benefits, $55 trillion. They have their social security, it's like their CPF, $41 trillion. These are obligations that they have to meet when people drop the money for medical or for their social security. So these all add up. You can see what a huge debt the US is in. And that is why they have to continue printing money, right? So let's look at the back on the Singapore front. Can we print money or can we print land? US can print money, but can we print land? In Singapore, let's look at the land use. Okay, by 2030 in Singapore, housing will make up 17%, okay, of the land use. Others 4%, ports and airports 6%, defense requirements 19%. This cannot be cut down because a lot of these defense requirements, the land is also used for water catchment. Okay, so you can see that with a population of by 2030 between 6.5 to 6.9 million people, we are increasing. We can see that because of the increase, the land use by then for housing will be 17%. The previously, the land use was only about 14%. So they increased the land use, but you can see that land in Singapore is really finite. We don't have much land in Singapore compared to, let's say, in Hong Kong. Hong Kong has a lot of land that is non-built up. 76% of their land is non-built up because of the terrain and whatever reasons. But you can see that the amount of land that is used for housing in Hong Kong is only 7%. Okay, we have already used how much? 17%. Compared to Hong Kong. And that's why the Hong Kong prices kept escalating, right? So these two factors, inflation, currency devaluation, will decimate our purchasing power, will decimate our income and our savings. So these two we have to deal with. So inflationary pressures as well as currency devaluation. So let's look at so if we have knowledge-based risk management and we can understand the fundamentals and the economics that drive long-term investment decisions. However, for short-term, usually the markets are overcome by greed and fear, right? Greed and fear tend to drive short-term trading, but fundamentals and economics drive long-term investment decisions. And you can see that it isn't just about minimizing losses, but it is about not letting fear get in the way of optimizing our investment outcomes. Okay, so let's look at what we need to do. The goal is to be prepared. So in times of great uncertainty, let's look at how the right Singapore property can be a safe haven for us and in the long term to outperform. Okay, using our funds to outperform. So let's look at what the rich are doing. The super rich are choosing Singapore as the world's safest haven. And this article in Bloomberg is just recently on the 27th of May. Money is sloshing around Singapore like never before. Family offices, Bentley sales and real estate prices are booming. So this also, okay, this is also about family office. Demand for luxury penthouses holds steady in spite of the pandemic. Good class bungalows prices also keep going up. So you can see that our real estate, our good class real estate, okay, are in huge demand by the foreigners who would like to park their money here in Singapore for various reasons. But then in Singapore, we have a lot of measures in place, prudent measures in place since 2010. So because of that, because of the cooling measures, our prices have not gone off the roof. Okay, because of total debt servicing ratio, additional buyer stamp duty, and so on. So all these measures have kind of put a cap on put a lid on the on our prices in Singapore. So we are relatively the property prices are relatively affordable compared to the rest of the world. What's happening in top tier cities? The top tier cities, the prices are just running away like crazy. So let's look at the new launches from the last en bloc. Okay, so if you look at this chart here, this chart is taken from the latest URA statistics. So if you see all this on the left-hand side, bottom left, second quarter to fourth quarter, 2021 to 2025, that means within these 4 years, we have a total of 49,000 units that non-landed residential units that will go TOP within this 5-year period, 49,000 units. And if you look at a bit closer, it shows here that this 4942 will TOP, okay, in 2021, okay, in 2021, right? But out of this, 71% have already been sold. This here, 1,436 is the balance amount. And so this ones in orange, same thing, you will see that for this segment that is colored in orange, they are supposed to go TOP in 2022. But out of these, 74% had already been sold. What is balanced unsold is only 2,984, and so on and so forth for the various years, until you can see by 2025, the units that will go TOP in 2025, there are only 4,789 units that will TOP in 2025. Now, as you all know, the supply of units is inelastic, is fixed. There's a construction period. The construction period will usually need 3 to 4 years, right? Minimally for it to TOP. So it takes time for units to go TOP. So what is available in the market right now? All right, let's see what's happening in the market right now. What is available in the market right now is a summation of all these colored portions, okay, for this 5-year period. This is the summation of the of all these. So instead of 49,000 units that was supposed to go TOP, what is balanced unsold is only 22,867. 22,000, or if you divide by the time that we have over here, you divide by slightly less than 5 years, because the first quarter is already passed. This is taken from the first quarter 2021 statistics. You can see that if you divide by the number of months available to sell, we only have 4,814 units to sell per year. Okay, but what is more important is to see what is the demand. We have these units to sell from now on, 4,800 units as of second quarter this year. But what is the demand last year? Last year was also a pandemic year. The demand was 9,982, but we only have 4,814 units per year to sell. In fact, if you look at the long historical data, between 2009 to 2018, the take-up rate, the new take-up rate was 11,400. Okay, but the average net new supply between 2021 to 2025 is about 10,000 units of supply per year. So you can see that it kind of matches off. If you take in the if we include last year 9,982 plus in 2019 the number was 9,912. Okay, so if you take an average of this 12-year period, the average is about slightly over 10,000 units per year in terms of demand. The market demand in Singapore in the last 12 years is about 10,000 units plus per year. But what we have available for sale over the next few years is only 22,867 units. In fact, these 22,000 units will be sold in the next 2 years. If the take-up is 10,000 a year, 22,000 will finish selling everything in 2 years. We won't have much to sell in 23 and 24. 23, 24, we may have nothing at all to sell unless you go for resale, right? But the new launches, that's why all the new launches now, if you notice, whenever there's a new launch, you need to go ballot, and usually on launch weekend, during the launch weekend alone, about 60% of 60 to 70% of the units have been sold during the launch weekend. So the demand is very, very strong. What is available, the available stock in the market to sell is very, very little. So if you can see that, okay, in beyond 2025, right? Beyond 2025, what is the number of units that we have in the market is only 1502. These are without the prerequisites for sale. That means these are without sales license yet. Okay, so the developers are applying for sales license. So you can see that what beholds the future, okay, it's determined a lot by the supply of land. So this is the supply of government land, and you can see that dark blue shows you the total units that's released for sale. These are on a confirmed list or already triggered. And then the light blue stands for units on the reserve list. So you can see that in the last for first half of this year, we have somewhat increased the confirmed list. Yeah. But however, it's still insufficient. We still need to have a lot more land sales. Otherwise, if there is insufficient supply in the market, prices will continue to move up. And if you are asking for discounts from developers right now, if they're selling so well, why should they be giving us further discounts, right? Because the supply is so limited. And of course, all developers are there to maximize their profits. So the later we wait, the higher the prices will go for sure, because of the lack of supply in the coming months. Because even if they have triggered the GLS sales this year, this will only be ready when 4 to 5 years down the road. By then it will be 2026, right? 2026. If from those that are land sales this year, they will TOP by 2026. So in the next few years, there's really nothing much in the market for sale. And yep, so let me just carry on this. Okay, these are the en bloc numbers. Okay, en bloc, only slightly over 1 billion of deals were struck since the cooling measures on 6th of July 2018. So you can see that in 2017-18, there was a lot of en bloc going on. But since 2019, after the cooling measures set in, we have so little en bloc, right? 2019, so little. 2020, only 2 small ones. 2021, I don't remember seeing anything in the market at the moment. So, of course, going forward, okay, the en bloc market will be coming on stream maybe next year, right? As more and more sales committees get ready their condos for collective sale, it takes time, right? So maybe next year, 2022. But in the last few years, right, since 2019, there isn't much en bloc going. If there isn't much en bloc going on, it also means that in a few years' time, there is very limited supply of freehold land. Okay, leasehold land, definitely, if you buy into leasehold, your return, if you intend to invest, your return will be fast, right? Your smaller outlay will augur well for the fact that your return will be higher. But for those who are going for freehold, you can see that for freehold, there is very, very little supply in the market. It's not like government land sale where you can release more land and then it will come off. But for freehold, it's totally dependent on collective sales, on en bloc sales, and there isn't very much en bloc sales going on in the last couple of years, since July 2018. Okay, so you can see that look at this chart here. So this is declining overall inventory and unsold completed units. So first quarter of 2019, there were 37,000 units. First quarter of 2021, the supply has overall unsold inventory dropped to 21,000 units. So you can see that it has dropped the supply within 9 quarters has dropped 42%. And you can see that whenever this line here shows you the average, okay, about 32,000 units. So this 32,000 units, you can see that whenever it kind of goes down, there will be an en bloc fever coming in. Whenever it goes below 32,000 units, en bloc fever will come in. And you can see this dark blue line here. This dark blue line is the unsold completed units. Unsold completed units that still they have not obtained the CSC yet, but they have completed but unsold is now down to almost zero, very little left. And the stock inventory in the market has also come down substantially. You can see this red arrow come down substantially. So the supply in the market, the inventory, whether they are completed, under construction, or with planning approval, okay, all the stock, the total stock in the market has been declining substantially. Okay, so Singaporeans over leverage, you can see that the total debt obligation by the Singaporeans, mortgages and personal loans is only $318 billion, but their assets in CPF, in their cash holdings, total 973 billion. You can see that the debt is only 33% of the cash and CPF. So are Singaporeans rich? Yes, they are. Okay, so let's look at are they over leveraged in the past, right? Mortgage payment versus income, 78%. Right now, in 2008 was 45%. This will not cannot be sustained. So therefore, it has been coming off. And right now, it stands at, for private properties, it's standing at 29%. For HDB, it's 21%. So the mortgage payments is only a small percentage of their overall income. Okay, so in our search for an outperforming real asset in times such as this, let's identify what we have to do if we were to invest in real estate, okay, in real assets. So the country, why Singapore, the location, why core central region, the planning area, why not all locations within CCR are equal, and the project, why only certain projects are worth investing in. So let's look at Singapore, okay? Political stability, safety and security, stable Singapore dollars, good infrastructure, transparent rules and processes, pro-business policies, global business and financial hub, conducive tax environments. These are the very reasons why a lot of foreigners are looking to buy into the Singapore markets. And of course, when travel bubbles are in place and vaccines are being rolled out and the pandemic is under control, if the foreigners are able to fly in, there'll be even more sales in the core central region especially. But right now, even right now, they are buying through Zoom, they're buying through virtual tours and so on. So let's look at the Singapore core central region, right, are the orange colored ones. This whole area, the gray and the orange, this is the central region. The rest are considered outside central region. So classification by postal districts, a lot of us are familiar with postal districts, but for the authorities, they do not plan by postal districts. They go by planning area. Okay, so by planning area, let's look at the ones that are highlighted in yellow. These are the core central regions, CCR. Okay, these are the core central regions. Now, the core central region is made up of district 9, 10, 11. It's made up of districts 1 and 2, parts of 6 and 7, and Sentosa. Sentosa is part of district 4. So this is what I call the traditional. The orange portion is the traditional core. The blue color is downtown core and Sentosa. So the location, why core central area? That's the region of choice for funds. For foreigners, they only like to buy prime properties. For locals, they have an added advantage over foreigners. And for investors, they see good demand, good rental demand, better tenant profile, and potential for better capital appreciation. So the questions to ponder over are, in OCR, who are the buyers? In RCR, who are the buyers? In CCR, who are the buyers? So if you were to buy in a certain location, do you have any advantage over your neighbors? If you buy in OCR, for example, okay, in OCR, which nationalities are the buyers? Mainly Singaporeans. So if many Singaporeans are buying, for example, and you're buying investment property, you have no advantage over other Singapore. If you are a Singaporean, you have no advantage over another Singaporean. Why is that so? Because they pay the same amount of stamp duty as you do. But if you were to be if you are a Singaporean and you buy in a core central region where more foreigners are buying, you are actually buying cheaper than your neighbor. The foreigner neighbor is paying 20% more than you. When you can get out, they still can't get out. If you are a PR and you buy an OCR, you have no advantage over the locals. If you buy in CCR, you have advantage over the foreigners, for instance. And of course, if you're a foreigner, you swim where your people are. So you go to CCR, you're on par with the people who are also foreigners buying into CCR. But if you were to invest in OCR, for example, you will lose out to the locals who are buying OCR as their first homes. So that is why in CCR is a location favored also by homeowners. Investors flock to this area for that reason. And then of course we have to investigate what's the intrinsic value of the land. So this is just to show you purchaser's nationality, right? So if you look at in terms of quantum, lesser than $2 million, more of Singaporeans are buying. But the quantums that are, as the quantums go higher, Singaporeans are buying lesser, right? So definitely then the proportion of foreigners will increase. So you can see that for higher value homes, the foreigners favor the higher value homes. So not all locations within core central region are equal. So this is District 9 and this is District 10. These are the two most prime traditional districts in Singapore. And let's look at, let me go back to my presentation again. Okay. Sorry about that. Okay, so now I'm here. Okay, sorry about that. So you can see that these are districts 9, 10, and when we piece the two districts together, the ones within the red circle, right, within the red circle is the most prime and the most well demanded by the foreigners. So if you look at the planning area here, so this is District 9, right? District 9. District 9, you can see all the dotted red line here, right? District 9 is made up of District 9, this is map District 9, but this District 9 is made up of several planning areas such as Kallang. A part of Kallang planning area over here, Kampung Java, is under District 9. Parts of Rochor under District 9 as well. Part of Novena is also under District 9. So you can see that District 9 is made up of many different planning areas. But remember, the authorities look at planning areas, they don't look at districts, okay? So let's look at the most prime areas in District 9 and 10. We have the Tanglin planning area, we have the Orchard planning area, River Valley planning area, and the Newton planning area. And let's look at the development charges. Why do I use development charges? These are as of March 2021, very recent. Why do I look at development charges? Because development charges is like a proxy, okay? The development charge payable is like a proxy to the value of the land, because the higher the value of the land, the higher the DC charge will be. So if you look at District 9, this is District 9. Okay, District 9, you have several planning areas, you have planning subzones, and you can see that under Kampung Java area, the DC charge is only 7,490. Okay, compared to, for example, if you look at the River Valley planning area, Institution Hill, right, the DC charge is 11,900. So this shows you that the value of the land at River Valley is higher than the value of the land at Kampung Java, for instance, all right? And then if you look at the Orchard Tanglin planning area, that is the highest, 17,500. So not all locations, not all projects in CCR have the same value, okay, in terms of land value. And then if you look at the District 10, District 10 Bukit Timah is generally about 9,000 plus. Coronation area, 10,000 plus. Leedon Park area 10,000 plus. But this is still lower than Institution Hill, Leonie Hill. Leonie Hill is 12,000, or for that matter, One Tree Hill stands at 16,000. So this is how you measure the intrinsic value of your land. And then let's look at the, within CCR, we have the downtown core. Downtown core generally about 11,000 plus. For Singapore River Planning Area, about Robertson Quay is about 10,800. Okay. So why are certain projects worth investing in? Let's look at the 10 criteria. So if you look at Avenir is, I'm using this project for illustration for my case on hand. So very beautiful project. These are just a quick glance at the project facts. Okay, it's in District 9, it's freehold, land lot is big, the land size is 129,000, 2 towers. The former project, there were 4 towers. Now there are only 2 towers, 376 units with full concept surveys and TOP estimated to be second half of 2023. And then let's look at okay, so the location Avenir is very close to the MRT here, the Great Wall MRT. This road here is about 50 meters. There is a side gate here where you walk here to the MRT is, I think it's probably looks to me like maybe about 200 meters or so. Okay, so it's in a very good location near Great Wall MRT, amenities nearby. And you can see that this is from Google Map. Next to it is the River Valley Primary School, and this is the Singapore River, right? And you can see that the walk to MRT is just here. This is the entrance to the MRT already. So the location, if you see the map on the right-hand side, this is how you walk to the MRT. It is so close, right? Very good location, very good locality because it's near to Robertson Quay as well. Now let's look at the performance of River Valley. Okay, the dark blue line, River Valley versus District 9 versus the whole of District 10 since 2006 until now. Okay, you can see that in the past it used to be around the same, but now it has, the value of River Valley properties has gone up much higher than compared to the rest of District 9 or District 10 for that matter. So River Valley does attract investors because of the good returns that they get. So let's look at the developer. Hong Leong, Guaco Land, very good developers. They are both listed on the Singapore Stock Exchange. Let's look at the masterpieces by Guaco Land. They have done Leedon Residence, Midtown Bay, Martin Modern, Warwick Residence, Midtown Modern within this location. Of course, they've done so many, but I'm just naming a few in this location, in the CCR area. And then, of course, Hong Leong, they have done St. Regis, Ted Residences, Alto, Sage, and so on. So we have 2 very good companies coming together to do a JV. So who the developers are matter a great deal. The resale value of your unit matters to you, doesn't it? So let's look at the performance of some projects in the market. Look at project A to H. All this from the launch date. Okay, the launch date can be in 2018, it can be 2007, it can be 2010, it can be 2019. The prices tend to go down. Okay, it may whipsaw up and down a little bit, but the general trend is downwards. So you can see that certain projects, the price performance is not good. If you bought from developer early on, you can actually buy from the resale market much cheaper later on. However, for developers, for certain developers, their projects are performing well, whether it's in 2017, 2008, 2005. So I'm showing you a flavor of different time frames. And you see the charts, the performance charts, they're all upward trending, okay? Because there is demand for their project. So if you were to buy a project from such developer, you can be assured that prices will continue to trend upwards. So therefore, you can see that for definitely our 2 developers that I mentioned, Hong Leong and Guaco Land, their projects are listed inside here. Okay, so next, let's look at the consultants. Who are the consultants for this development? What's important, the questions to ponder over: who are the architects, who's the main con, who's the landscape architect, and so on. So for Avenir, the architect is Studio Milou, French architect. ADDP is our local architect working in conjunction with them. And then you can see that we have very good consultants on board. So this is the renowned French architect who has done he's glorified for his design works for reconstructing Singapore's heritage, and that is the National Gallery at City Hall. So he is a very well-known architect, Jean-Francois Milou. Then of course, let's look at the land size and the plot coverage. So most of the time, the plot coverage, what the government allows is 40% in the past, but now it's 50%. But for the Avenir, we have a coverage of 25 versus 75. That means the plot coverage is only 25. So we have a lot of landscaping and facilities, and that's what makes it a good class condo. And let's look at the project mix and the layout. So how many units are there in the project? What is the unit mix? Are they mainly shoebox sizes? Things like that are important. If the project is meant for investment to draw rental, what is the likely profile of tenants there? And what is the ceiling height, for example? All these matter a lot. So for the Avenir, you can see that our sizes, we don't have any shoebox sizes below 500 square feet. And we do have big units with private lifts. The smaller ones are in demand for investment. The bigger ones are in demand by the foreigners for their own residential purposes. So we do not have shoebox sizes at all. We have a good ceiling height of 3.2 meters. These are some of the photos taken from the show flat. Okay, so this is the living dining room of the Avenir for the 4-bedroom. The kitchen, very nice kitchen. The master bedroom on the right-hand side. The walk-in wardrobe, the master bath on the right-hand side. Now let's look at number 6, facilities and concierge service. So what kind of facilities do we have, and is there any concierge service? You can see on the right-hand side here, we have a whole host of facilities at the Avenir, including a tennis court. Okay, many projects right now, they don't have tennis courts at all. So this is the 50-meter lap pool. We have the hydrotherapy pool, the roof garden, the gourmet salon, the great lawn, a lot of greenery in this project. Okay, tranquility garden. So if you were to buy for investment, you rent it out, tenants usually look for facilities, okay, in deciding the price that they are willing to pay. Then we have the fittings and the provisions. What kind of fittings do we have? Is it marble? Is it ceramic tiles? So, and then the kitchen, are they locally made kitchen cabinets and wardrobes? Things like that will matter a lot. So how about the brands of the appliances, the sanitary wares and the fittings? What we have here is Vizuk. Vizuk is in terms of appliance, a Swiss company, more than 100 years old, very high-end product, usually installed in very high-end ultra-luxury condominiums. Okay, you get Vizuk, Hans Grohe, De Dietrich, Antonio Lupi is an Italian sanitary fittings, very, very nice, Antonio Lupi. And then the provisions for the kitchen cabinet, we have Nova Cucina. So this is an imported kitchen. So then we look at number 8, amenities and the surrounding. So what kind of access roads lead to the project? Is there traffic congestion? Is it a pleasant walk to the amenities nearby? Is there good connectivity? Is the MRT station within 500 meters? So the Avenir is just 2 minutes walk to River Valley Primary School, less than 3 minutes, I believe, to the MRT. The fare price 24 hours at Knini Road is only 4 minutes walk away. And then we have the Great World City, which is just about 5 minutes walk, and the Robertson Quay is about 5 minutes walk. So you can see that the walk here along the dotted line, right? It is a short walk to all the amenities. This is towards the NTUC. Okay, and then how about the MRT train? The Great World MRT station is ready by next year. Supposed to be this year, but it's been postponed because of the pandemic. And you can see that this MRT line is a very important line because it goes to all the right places. Eventually, it will lead to the Changi Airport, okay, Terminal 5, I believe, okay. And then it will go down south towards the CBD area. You go towards the east, and then it goes towards the north as well. So this is a very, very important MRT line, very much anticipated. So the surrounding, right, living in this kind of enclave, we have, is Robertson Quay the new place to stay in Singapore? Beautiful, beautiful surrounding, beautiful experience going to Robertson Quay. And then you have a lot of restaurants, cafes, food outlets, and so on. A lot of F&B offerings for you. And then hotels, malls in the area, just a 5 minutes walk to Great World MRT, short drive to Orchard Road itself, right? Even if you want to walk to Somerset, it's maybe about 12 minutes to Somerset to 313. And then, okay, let's look at the buyer profile. Okay, number 9 is the buyer profile. Who are the buyers in this location? What's the ratio of locals versus foreigners? And who are going to be the tenants in this location? So the avenue, I've showed you here, the Singaporeans are about 61%, foreigner 21.7, PRs 17.4. So PRs are also, in a way, they're foreigners with permanent residency status in Singapore. But generally, Singaporeans buying into this project is about 61%. Most other projects in CCR, you may see maybe about 70 to 80% foreigners. But at Avenue, 70 to 80% Singaporeans. But at Avenue, we only have about 60% Singaporeans. So we have a good proportion of foreign purchasers. And of course, if you are buying for investment, is it worth buying in to Avenue? What's the rentability? Can the unit be rented out easily? Can you fetch a good rental yield? What do tenants look for? And is there good demand in that location? So if you look at this chart, okay, you can see that for the vacancy rate has dropped. The supply of the demand, this is the demand and this is the supply. The demand has outstripped the supply. Therefore, the vacancy rate has dropped. Rentals are going up. Okay, I will not cover this. But generally, what this chart is saying is that rental rates will continue to climb. Okay, the overall increase in the improvement in the vacancy rate is 18%, but the recovery in the rental index is only 3.6%. Therefore, we do see that rental rates will continue to move up, continue to climb up. Okay, so landlords, congratulations. And then, of course, if you look at the number of units in River Valley area, in this River Valley area, these are the projects flanked by these 4 roads: the River Valley, Kim Seng Road, Havelock Road, and Clemenceau Avenue. If you look at the total number of completed units in this project is 37, 5,932 units. If you look at, I counted the rental contracts, and then if the vacancy rate is 9.5%, approximately owner occupancy is 2,113 units. Total rental units will come up to 3,819. So about 64% of the units in this area are up for rental, and rental is the backbone. Okay, rental is the backbone of the value of your property. If there is good demand for rental, the rental rates will be high, and because rental rates are high, there will always be a demand to purchase the property in that area. And because of that, River Valley has outshined many places, many other locations in terms of performance, in terms of price performance. So that is the reason why, because almost 2/3 of the units there is out for rental. It has good rental demand. So to sum up, we have the unit selling points: 3.2 meters ceiling height. Most high end about 3 meters. Mass market maybe about 2.6 to 2.8 meters ceiling height. But the Avenue is 3.2 meters ceiling height, very high, good ceiling height. We have full condo facilities, large land plot, so your exit is also easier. 75 to 80% land dedicated to landscaping. We have designer provisions, low density compared to the land size, and then efficient layouts, concept service. So this is the combination of the best attributes of the recent CCR projects available for sale. So will the project outperform the long run? Luxury projects in CCR have many attributes that mass market projects don't, and then therefore the premium. Discerning buyers will definitely be able to see value and the difference. So will it age graciously? Will the design stand the test of time? To me, what is very important is the intrinsic value of the land. Will prices of the development hold up well in terms of prices? So who the developers are also very important. So to seek out performance in the long term, one needs to closely study the factors that will affect future pricing. So this is just to sum up what we have Avenir as the good class condo. The Avenir, we have in a good location with good planning, subzone, high intrinsic land value, good developers, consultants famous for their works, large land plot, 129,000 square feet, and the plot coverage is only 25% versus 75% landscaping and facilities. We have the project unit mix and layout, good mix with larger units, not too many small units, efficient layout. You must go take a look at the show flats, facilities and concept service, good provisions, surrounding and amenities, very good, buyer profile, very good sizable proportion of foreign buyers, and of course rentability, very good, because 2/3 of the units in that location is up for tenancy, and that forms the backbone of a good investment properties with propensity for capital gain. So I have come to the end of my presentation. If you have a Propnex agent who's serving you, please do contact your Propnex agent to get them to bring you to go check out the Avenir. Or if you have been invited to this seminar to this webinar by a joint marketing agency, go back to the agent who has brought you, who has invited you to attend this webinar. Thank you very much for your attention this morning. Appreciate it. Thank you very much.
Thank you very much, Stella, for that very comprehensive look at that property. Right now, as promised, I'm going to award those 2 lucky winners. The registration is closed. You scan the QR code and clicked on the link. Let's give away 2 times $100 cash right now. I'm bringing out our wheel for the Singapore Property Show 2021. Let's give that first lucky winner his name or her name. Here we go. Who do we have? Who do we have? And the very first winner for this session, it's going to Alan. Alan, congratulations. You got $100 cash coming your way. Don't worry, I've got one more to give away. Let's give it another spin, shall we? Here we go. Alrighty, the second winner of that $100 cash prize is slowly inching its way there. There we go, Lip Huat. Lip Huat, congratulations. You're the second winner. Thanks for joining us at this session, and the SPS team will be in touch to help you figure out how you can, of course, redeem that cash prize. We've got a lot more happening for the rest of this Saturday edition. Stay tuned, of course, to the Singapore Property Show 2021.